It's indeed an undisputed fact that we had an inflated kind of valuation environment, but not just in the private equity and the venture capital industry. I think if we look at it from the macroeconomic perspective, it is a fact that we had a zero interest rate environment since more than a decade. And that meant that money actually was available for free. But rather than actually being used for transforming our industry and create growth perspectives and momentum in the employment markets and the like, we have basically created a parallel economy in the financial markets where everything has been inflated in value without those benefits, without those value gains or capital gains that have been generated arriving in the real economy. And I think that is the element that is about to change, and that is expressed in a kind of adjustment of valuations to reality, and also a increased need of using and deploying these amounts of capital that are floating around for real change that the economy currently needs. Well, I was always a big fan of the perspective that it is pointless as an investor in venture capital and private equity to try to time the market, because we always get it wrong. I mean, if you look at the first debates that have been happening about inflated valuations in the venture capital industry, that date back to 2015, where the big debate was, is it the moment to go out? If you had left the industry at that point in time, you probably would have foregone 100% of capital increase over that period. So I think if you try to be cyclical and to adjust to market cycle that you may perceive in the venture capital and private equity industry, I think you will probably face stable losses. If you try to actually constantly invest through cycles, then you probably will have cyclical returns, but it's returns.